Great job, guys. And we're going to go to manager selection. I got Andy Fish is going to be on that panel. Lindsay Sell, I'm probably assassinating your name. And Howard Cohen is on the internet, I think. Oh, no, Howard's not. I've got Howard's replica here. Yonyi. And Mark is doing double duty. So, Andy, you coming down? Fantastic. Introduce yourself, right?
It's like Michelle with an S or seashell with an S.
It's not over French.
It is. Alsace-Lorraine, French German.
Well,
There's your geography lesson.
bit of a chill on the outlook, but look outside. The weather is absolutely gorgeous. Couldn't ask for a better day here in September in New York. Thank you, Marty, for the opportunity and for our distinguished panelists on this panel of manager selection. My name is Yonyi Dolan, a longtime advisor at the nexus of capital, industrials, and technology. Worked for a long time in the Israeli tech ecosystem, sourcing deals, working with portfolio companies, representing principals, and spent a lot of time with family offices. So really excited to host this panel today on manager selection. Today, I hope on this panel, we'll cover three themes, largely: trends and structures shaping the landscape, operational readiness for managers, and legacy and values driving family office allocations. So we have three distinguished panelists here. Andy Fish spent a long career selecting managers. Mark Kyle brings the broker-dealer and capital raising perspective. And Lindsay Sell, who does a lot on the legacy side. So, can I ask you all to introduce yourselves?
Yeah, Lindsay Sell, like Michelle.
Great.
Okay. Hi. All right. Lindsay Sell, like Michelle with an S, and a health and wealth and legacy expert, as Yonyi mentioned, a family office executive and a founder. I also have co-hosted Resilient Alpha, so I'll put a plug in for that, and also as a guest on that. But basically, over the past 20 plus years, I've worked in both public and private markets, spanning Goldman Sachs, D. Shaw, a fund of fund, which would now call itself a family office. In fact, it was bought by a family office, which was then bought by a multifamily office. I helped a constructive activist. I took a farmland company. I know we were talking about soybeans on the last panel randomly. I took a farmland company public. I got to ring the bell at the New York Stock Exchange. Everybody should do that at some point. Any Cornellians out there or online, go Big Red. Really, I've just seen markets evolve and have been a source of product innovation, strategic relationships, and capital formation through those cycles, which I continue to do, honing in on the inextricable link of health and wealth, especially with intergenerational transfer that's happening within the family office space, which I'll get into. I also have two amazing daughters who you'll hear more about during, I'm sure, this panel, and I'll pass it over to you, Mark.
Well, thank you for that, Lindsay. You just heard me for 40 minutes, so I won't take a long time, but I work with Pickwick Capital Partners. We are a capital raising shop for both companies and for funds, so it's always great to see both the ends of this work. And I'll look forward to sharing my insights and thoughts with you on this topic.
So we are three virtual multifamily offices. Never mind that part. What we do is we co-invest with companies or managers. So in terms of manager selecting, has to be a partnership. I spent my first 20 years inside a multifamily office that was captive capital, raised no money, no sign on the door, no outside managers. And there's a reason I'm telling you that part. Ran 2 hedge funds, 3 venture funds. So 20 years later, I went to State Street Bank, State Street Global Advisors, the asset management arm, and they were starting a fund of hedge funds. I had already designed one for the family offices, and they said, why don't you come do it here? So I went from family office to the institutional world for 15 years. I built and ran a global multi-billion-dollar fund of hedge funds. I'll brag a bit. We won a dozen awards, lost no money in 08, invested in 26 countries, and my sole job was picking managers. So the reason I'm telling you both is because this is the family office world, and I don't think you folks are going to invest the way we do today with a co-invest model. That's another whole conversation. But what I will do is take my global fund-to-fund hat and put it in the context of what family offices can do in terms of manager selection.
Great. So on that note, given your experience with manager selection, looking ahead, what trends in manager strategies and structures should family offices be paying attention to?
So one of the things that changed dramatically in the last couple of years for when I say family offices, I'm talking about people that use RAAs, wealth managers, that you're invested in public securities, funds that are public securities. So of course there's ETFs. They're all passive and skip those. So it's active strategies. A lot of institutional managers, and this is what Mark asked me to bring up before, are putting their strategies or trying to, certainly putting their name behind things that are available to literally call your broker, interactive brokers, press a button on your phone and buy it. So here's the issue with manager selection. When it's a private fund, you have a different relationship because depending on what you do, the fund is used to dealing with people one-on-one. Now, as a individual, it's very hard to do that with large funds, but this all depends on how much work you want to do. The issue I'm trying to get at is that you lose a tremendous amount of transparency. So what you need to focus on there, if you're looking at something listed, is how much of what they did well in the private version got translated into the one that you can buy and how much is left out. Because what you can't do when you're pressing buttons is know all that much about the manager. My Bloomberg's got a little summary about that long.
I'll jump into that. And I think what we're seeing is the confluence of a lot of paradigm shifts. I don't like the word trend. Trend sounds all like fatty and maybe it's going away. But these are all paradigm shifts. So I'll start with last March, I was at a very heavily women's focused event hosted by a large bank. And I mean, it couldn't be more kumbaya if we tried. It was women executive of Wall Street. I felt so honored to be invited. And it was a packed room of us on the top floor, so high up, I had vertigo. And we were watching a documentary produced by women about women founders funding women, funded by women funders, right? So it really could not be more. And so I, being me and the way I think with an innovation mindset, said, let's deconstruct this event. Why are they hosting this event, right? Why is this so women executive focused? And I thought, oh, right, because we're a cohort that's getting a lot of the money. So if we look about where, what's happened, right? Some of you know this statistic who've heard me say this before, but I'll ask, for those who might not, how much money do you think is changing hands intergenerationally? Because this is a family office kind of focused arena between now and 2048. Can somebody just throw out a number to start?
35 trillion. No, yeah.
1 trillion, 35 trillion, both wrong. We'll go Price is Right rules. Who else wants to guess? What? 70 trillion? No, last one, Marty. 150, that's the closest. 124 trillion, and it's probably plus or minus. Who cares if it's plus or minus 25 trillion? So I'll give it to you, Marty. 150 trillion. Fine. But that would be wrong by Price is Right rules. I know. Never mind.
Marty's out.
$1. $1. But of that 124 trillion, okay, about 40 something trillion are going to older women, surviving spouses, gray-haired divorces, and not because they lack intellect, but because of generational dynamics at the time. There's a tremendous lack of financial literacy. So that's one element I'll come back to. Another cohort inheriting about 50 to 60 trillion are Gen Xers and millennials, right? So both of those cohorts who are inheriting a ton of money think very differently than the generations that were making allocations decisions 1 or 2 decades ago. You think Mad Men era, here are your stocks, here are your bonds, let's ring a bell for a penny stock. There's a lot more thoughtfulness that goes into structuring impact value systems, what I'll call legacy investing. And so that's one element. The other element is, and it was touched on before, is this notion of 60-40 plus, and how a lot of banks, RAAs are kind of late to that. And I hate to use the word game, because it's actually investments, for the long term that are compounding. But they're late to that paradigm shift. So what are they doing? They're making stupid acquisitions. BlackRock acquiring Preqin to say that they've made an alternative acquisition when that Preqin's like an outmoded CRM database doesn't quite fit. But also when these RAAs, and I know I've worked with, and I know some really great people at some of the top ones, are making these strategic acquisitions. They'll acquire like this one out of Detroit and this one out of, like, I don't know, Depaw, whatever. The group at top that's setting these alt 60-40 plus allocations, and it's actually only, I think, Larry Fink who actually put a number out there, right? He said it should be 50-30-20. Nobody else was really said, what should it be? It's kind of just like something. But the small firms that are acquiring are not getting that. And they lack the education when they're structuring and informing their clients. And so those clients are not necessarily family office clients. They're more what are called like the Henrys, right? The high earners not ready yet, who are really leaning on the RAs and their advisors for advice. So I think
60-40 is heavily dominated by institutions, pensions especially, because they all manage to a benchmark.
Right.
Family offices do not manage to a benchmark, so they don't have any reason to follow that philosophy.
And we'll come back to that, because it's like we're at the upending of the endowment model, but that's a whole other conversation. Totally. Yes, different panel. So again, I think to answer the question and to dovetail off of what you said, Andrew, I think where investments are going from the family office space are heavily going to be impacted to where the capital's coming into. And I think that what we're going to see is REAs, advisors, and banks kind of chasing those cohorts that are inheriting the money and trying to cater to that. And there's a lot of catch up and innovation and clear first mover advantage still out there.
Already well underway.
Yes.
There's a huge wave.
Yes.
So how are families actually operationalizing that idea, making allocation decisions, Lindsay?
I put Diet Dr. Pepper to my oat milk vanilla chai. Does not taste very good. So how are family offices operationalizing that? I think that's an excellent question. And that comes down to, like, let's take a big step back, and how do we define family office, right? So a family office is essentially when you decide to have an independent entity to manage wealth that you've otherwise acquired. But maybe you're a real estate family or an oil family, you made a lot of money, and now you want to set up a separate entity to manage that. And I kind of use the Forrest Gump, life is like a box of chocolates. You never know what you're going to get. Every family is kind of different age, different stage in their operationalization of that. And I'll say I heard one of the founders of, I think, Seamless Web describe this, and it was described so well. There's first like the part where it's really family, right? I'll be like, all right, Mark, you seem to be more investment oriented. You got that. Andrew, you're more finance oriented. You got the Excels in the back office. I'll handle the relationships. Let's do it that way. And then you realize, okay, we got something good. Let's hire some more people, maybe family members and other, and becomes more of a tribe. And you're hoping at least you've developed some sort of ethos or value system or governance structure at that point. And then you come a little bit more institutional, and those tribes become actually separate, almost departments, and it becomes more operationalized. And what you're hoping is as you're building and as you're growing, you're maintaining that value system and that legacy and that structure. And it all comes down to, as you're doing that, as that family office entity becomes more institutional, more akin to maybe an endowment or a pension, it's the 4 Ps, right? You want to make sure you have the quality of the people, you maintain the philosophy, you're sticking to, and I'll have another movie quote. I know you're chomping at the bit, Andrew,
No, I just
performance
to add
and
some
then
clarity
process.
to something that kind of touched on a whole lot of things.
Yes.
I'll try to make it
Yes. Okay. Perfect.
simpler. Okay. Remember, last panel, Suzanne, I think she left, said,
It's right
you
there.
know, if you're not working at it, give it to somebody else to do it. Okay. That's one type of family office. You still have people, it's their money. Maybe they have values. They want to direct it, but they're not hands-on making those types of decisions. Quite frankly, they're not qualified. And what I mean by qualified is what you were talking about, which is, and I'm making it black and white. It doesn't have to be, which is that if you're going to do it right, you either have people in the family committed to it, which you don't always have, or your family office has hired a small team dedicated to doing whatever it is that you do. I'm trying to make it simple and bifurcated between those two things.
Yeah.
So now this is a manager selection panel. I'm going to try to not get into macro and all kinds of other things. So when it comes to that, you now have two different situations. You have one where you have to find trusted advisors. You direct them to your general needs and they will work on what the family wants to do, but then they have to go out and implement it. So your job is simply to figure out whether they're any good at then manager allocation, not you going out one by one. The flip side would be that you have an idea, you have a construct, you have to get organized between your family, whoever works for you, and any outside advisors, and you have to have a strategy. Now, you don't have to do everything. You don't have to cover the whole world. In fact, you shouldn't. But again, I'll quote Suzanne, diversification is important. You can't have all your eggs in one basket. But with that said, it's work. And some families have people that are really interested in doing it. Some people have families that are of no interest in doing it. I have two ex-wives from the business, by the way. You need any women, they don't like talking about it. But I also have two daughters.
Another conversation.
But I have two professional, successful daughters who want nothing to do with the financial industry. So, and if we had a family office, and I wish, but we don't, they would want to have nothing to do with what we are talking about in this room.
I think you also have to look and think about, initially the family makes its money from a business.
Yeah.
And so when they form a family office, one of their first goals is to diversify away from that business and try to reduce their basket in that area and try to get outside to provide some stability, to provide some forward progress, things along those lines in terms of not having too much risk in one area. So I think you have to understand what stage the family office is in, what the characteristics of that family office is. And as Lindsay said, everyone is different. And of course, as that family becomes 2-generational, 3-generational, the needs of that family change dramatically.
Yeah.
Wait, before you go on with Mark.
Yeah.
So Mark's correct. I'll add one thing to it. Very simple. There isn't one right way to do it. There are tons of wrong ways to do it.
Totally.
So I'll just give you two words that every family should try to embrace. Best practices. All that means for whatever you want to do, you figure out and be deliberate about how you're doing it.
Yeah, that's the P process right there. And what you were describing before, Andrew, it's like I call it the want to, can't do. If you have a family that has all the best intent, but they realize they don't have the skill set, then they would maybe go with an RAA or hire an OCIO or hire a smart team internally even, right? There are different solutions to that. And in terms of, I'll give a quote from the two quotes, okay? I'll give one from The Godfather when Clemenza says, take the gun, leave the cannoli, right? It's kind of like, what is the cannoli and how does that have anything to do with manager? I know you love this one, Marty. But it's like cannoli is what you value, right? So when you're a family office entity, it's kind of setting up your investment objectives, or in that sense, and the returns you're seeking. So the large family office that I was recently aligned with helped build the World Financial Center. one of the times they were the largest owners and operators of New York City real estate, right? So a lot of real estate success there and profitability for the family. Fourth generation, 650 members. So we essentially were a mini endowment. Not every family member was involved. Thankfully, that would be a very big family office in one building on Wall Street. But the alternatives entity, therefore, was focused on hedging market risk and hedging against real estate risk, and essentially also at times acting as an ATM for real estate needs. So what were our focuses? Liquidity, downside protection, consistency of returns. That's very different, let's say, than a family office that maybe made their money elsewhere and is more, younger generation led and it has a higher risk appetite and might not want, and we only invested in funds, which is another decision. You can invest in funds or invest directly, right? And wants to invest directly and take more risk intent. The last element I'll talk about, and this will come up again and again, is, because everybody here wants to make money for their families, is the notion of currency. And the currency of relationships is one of the most undervalued currencies in our industry. Every fund, every service provider, everything, it's all a relationship test, right? How you act, how you react when you're hiring a manager. It's for their strategy, it's for their track record or their track record they came from, or they're an emerging manager without a track record. It's the relationship and the trust therein. So, as Warren Buffett and Fight Club, right? First rule of Fight Club.
There's no Fight Club.
No. You're not in the club. Get out. No, first rule of Fight Club is don't talk about Fight Club. Second rule is don't talk. How does that mean? Never lose a meaningful relationship. As you're building out and selecting managers, their relationships, they should be maintained unless there's a differentiation or style drift in the strategy that raises a flag. And I'll pause there, or we'll just kind of
I want to dive into manager selection because that's what we're supposed to be doing. But but you had an emphasis that I want to change on the audience, because I don't think you're necessarily wrong. I think it's the message. So when you're talking about family offices, Mark just talked about family that sells a business.
Right.
Now they have a lot of money. They have assets and they have children and whatever, right? So, and remember, I spent 20 years buried inside a whole bunch of families. And so this is not lost on anyone. She said returns. No. The first thing families should look at is capital preservation. Now, you talked about hedging and things like that at the end. That's after you've invested. But before you go forward, before you look at how much you can make, before you look at where you are investing, and she used the word risk tolerance. So let's use that more broadly. The family has to decide the balance between investing money and protecting capital. And I don't think there's any family office I've ever run into that wants to take so much risk that they're not protecting the core of their family office. So when you're at a cocktail party and the guy's talking about Bitcoin, trust me, that whole family's wealth is not buried in Bitcoin. Well, is one of 1,000 maybe, but most of them have something much more conservative, much more solid, and that's the cocktail party investment.
I'll riff on that a little bit. I think you're entirely right. However, I think with the intergenerational shifts and the cohorts that are inheriting the money, because I agree, your experience is spot on, and capital preservation is certainly key when you're compounding wealth for legacy and multiple generations. Is that I think I've learned that in my experience with family offices as building community now versus then, is the question really isn't what are your investment objectives, and it isn't your focus on capital preservation. Those are both part of it, but is really what is your value system? What is it that you're trying to achieve, and what are the goals? And building a capital strategy and an investment strategy as part of that. Almost like the industry is looking at the wrong pie. The pie isn't just your investment objectives and that 60-40 or 60-40 plus funds.
See,
it's broader than that.
They're not mutually exclusive.
No, they're agreed. It's embracing. I'm saying it's not just, it's broader. It's broader. Totally.
So
And a lot of it depends on the personality of the people that are making the investment decisions too, right? So if you have somebody that came out who's made his money and he has friends and he knows they introduce him to good deals, they're going to look to make good deals for themselves. Now, the important thing is how do you balance that to preserve the wealth, and how do you then make the decision how much to allocate to that strategy of buying companies or private companies or investing it in certain areas that might be more risky. And that is what the governance issue is supposed to answer in all this. And with the governance and the process issues of how you go through this. And I think Andy and Lindsay are both sort of saying the same thing, but
Agreed.
obviously have very divergent views on how that's done.
Let's take the next question.
Sure. So I had a question for
Interesting
Mark.
investments.
With Mark, you've been relatively quiet. So you spend a lot of time prepping managers to raise capital. And I want your take on what's the biggest mistake managers make when they think they're ready, and what should families watch out for?
Well, the first thing is usually when managers come to us and they think they're ready, they think it's going to happen much quicker than it's going to happen. Mistake number one. We have a fund right now. This guy's convinced he's going to raise this fund in 90 days. I'm there. Well, let me tell you, we're going to be out here for 18 months. But he thinks, oh, I know all these people and they'll invest, and they're going to be the first investors in the fund. They'll have a quick first close. And that's very important towards the process. But really, the most important thing is you got to get everything together before you go out.
Mm-hmm.
You need to have everything lined up. You can't have one thing in the PPM and another thing in your presentation. They have to say the same things.
Mm-hmm.
And you need to check that over and over again. And as you go through the process, your PowerPoint changes because your returns change or whatever. So you have to make sure it still aligns with your PPM. So you need to do that. I'll tell you a quick story. I took out a fund manager once, and they called me up and had a successful meeting, and somebody said, I want your subscription documents. This is shocking. It was so quick. So like, great. Let me call up the fund manager. And I said, look, they need your subscription documents. I will tell you, I was early in my career in this business. And they said, good, we'll just call our lawyers and get it. Well, 8 weeks later, I get the subscription documents. I send it over to the person I wanted, and he's like, and long gone.
Yep, too late.
Too late, over. So being prepared, that's the real key. And don't think it's going to be quicker than what it's going to be. It's going to take a while, especially in the market we're in right now, unless you're in a really hot area.
So Lindsay was talking about trust and relationships. I want to separate that concept into two distinct areas. Okay, is now our fund of fund, because I came from a family office world into one of the largest banks on the planet, but it was an experiment. So I came from a place where we never had meetings, didn't wear suits, didn't have titles. There wasn't even a freaking name on the door. When in 1989 we had $1 billion in a trading pool. I don't know what's that in current dollars today. I have no idea. But that's not the family's wealth. That was just what their investment pool was. They all so some of them were very interested in being involved in the situation, and was run very professionally by those families. That's why I was there. I wasn't. They didn't bring me in because of my money. Didn't have it. But there were also families, and this is important to what we were talking about before, who had their capital there, but had zero interest in what was going on. They trusted the people running it because these families all had relationships. And one of them is a famous designer. So I had custom suits that I could only wear to funerals because I never needed a suit, but never had any interest in the investment part. So this goes back to even a family where before Lindsay was talking about, well, there's this generation, all that. So the people that are doing whatever also have to respect the people that don't want to.
Mm-hmm.
So you're right about setting guidelines and views and all that. Anybody can do that. But those two people have to be coalescent. And one of the reasons I ended at State Street was that broke down after 20 years. And those people were not in agreement and not in sync. There's nothing I could do about it, you know? So I want to get to the part, and then other people can talk about it, where the trust part is different. So first of all, if you're taking, Suzanne's like, okay, we're going to find somebody to do this for us. That relationship and that trust, it is all about that. It's all about that. You're not doing due diligence on them. You have to trust that they respect your views, that they have the knowledge, they have the team and the ability to put into place and protect your capital. Okay. That is very, very different than going to a manager. Now, this is a different, I'm not saying no relationships. I had tons of them, but let me just give you two extremes and I'll let them talk. So you have a manager that runs a systematic quantitative trading strategy in futures. Okay. How important is that relationship? Zero. You go in and you do the work on whether they are any good at what they do. What is their process? Do they follow it? And we had, I had one manager for 20 freaking years and didn't really have to talk to them all that much. Now, by the way, I have 3 million frequent flyer miles because I ran it differently than fund to funds. I did the most meetings, not my portfolio managers, not the analysts. It was the upside down model of what other people did. So I knew everybody we were invested with. On the other side, you have people that are trading credit in Asia. By the way, the last panel. So when you do credit in Europe, you only do credit in beer drinking countries. You don't do credit in wine drinking companies. That was the rule of law part. And in Asia, you only do credit. Your evaluation is what do they have to lose by not paying me back? Because that's the only way you're getting your money back. So my point is those relationships matter a lot, but you can't get married to the investment. So the last thing I'm going to say is if this is 2015, we're having a very different conversation about manager selection because what you are looking for in skill sets, abilities, and how much information they will give you, how much you need to learn. Is different than it is today in an environment where things are starting to get messy, and that was talked about before. So again, how much work do you want to do? So the one last thing I will say is all you have to do, and not the wealth, we talked about that. That's trust and everything else. All you have to do in manager is figure out that you know enough to figure out whether they are any good at what they do. And then you have to follow it. And I think Suzanne said something about them getting off track, or if they lose money, losing their discipline, whatever. That's just monitoring. But to pick a manager, your job is to know enough about what they do to see if they're good, not so you can do it yourself.
Yes, which I think the only point that I would almost slightly phrase differently is I think that is an important relationship. I don't outright disagree with you. You have a lot of tremendous experience, which I very much admire. But yes, I think even if, and having worked, I worked in the inside of Dijah, one of the darkest, biggest black box firms ever, intentionally in their finance and operations department to understand what happened in the belly of the beast, right? But when, and I've interviewed managers, I remember going to see one and their literal prompt was basically like, you know, whatever, C code / I am God, you know, and like, we were like, that is a very overconfident quantitative trader, but that said something about them. And when you're investing in a manager, it's the relationship that you're investing in as well as the strategy, because you're trusting the manager to do what they say they're going to do. And when markets shift and their strategy is underperforming, I would say, it's the managers where you have the relationships and you understand the strategy and are they supposed to be underperforming and that you trust in what they're doing and that's okay? Or are they performing differently than they should be in these markets? And is that a flag for concern?
Well, that's what I was saying.
Yeah. So,
and the relationship will be about what they tell you. Because if you don't have a relationship, you're right. But I just said you can't get married to them. I didn't say you shouldn't have a relationship.
Do you have any questions
So-
from the audience?
And from a twice divorced guy, there's a difference. So that's all I'm saying, because she's right, because when things go wrong, and they always do, if you don't want them to go silent and you're just sitting there going, what the heck is going on?
the tip I'll throw out there from having been on the side of the manager that's trying to, or the emerging fund that's trying to raise money and go public or stay private or whatever the goals are, 500 million, a billion, multiple billion, and on the side doing the allocations from an institutional and family office perspective, it really comes down to, ironically, it's like a 4-3-2-1, right? It's those 4 Ps, making sure that who you're investing in, whether it's direct or a fund, has what I discussed before: people, process, performance, philosophy, right? And that as the entity grows or the investment grows, are those staying or growing and changing appropriately, right? Then the 3 is it, and this is really important, right? Because this goes down to the 8 weeks for the subscription document. It comes down to the why this investment, right? Like, why does it make sense? I was just interviewing somebody who grew up in the hedge fund world and is starting a fund, and their why this is because I was exposed to it and I think I'm good. I'm like, that's great. You're like one of 1,000. Good luck, bud. But like, it's why this, why us, why specifically this manager, what makes you qualified and differentiated, right? And why now, right? Especially if it's an open-ended fund or a closed-end deal, right? Right. And the strategy, right? Like in a, is it tariff resistant? Is it uncorrelated to current markets? Is it an inflation and deflation hedge? The farmland fund I took public, one of the reasons it was so successful at the time after the great financial crisis of 2008 is that it was an inflation and deflation hedge. People eat better, eat more in inflationary times, and deflationary times, you're running out of food at the grocery store. So answering those 3, especially the why now, and then you don't even have to open your deck if you have the why now.
For Mark. So Mark, because you
Let
were,
me just finish.
I thought you were
No,
finished.
4-3-2.
One.
Two-way communication. Make sure that you're communicating and proactively and in the right manner and not over communicating. Right after I did this at one panel and I said specifically, don't find me in the bathroom, a manager came to me and found me in the bathroom and said the answer is just no. Like, sorry. And one is one value prop. And the last element is answer the GOTRs, the get out of the room questions, right? So if you're a small emerging manager or in an emerging asset class, or even a big manager, or this person I was talking about, like, be prepared to answer the difficult questions that a smart or logical or inept person would ask and have the right answers, right? So if you have a subpar accountant, maybe that's all right for your size and you have a plan to grow as you size up. If your assets are small and you've been around for a while, be prepared to answer that question. If you're an emerging manager in like a really, really fancy office, that's going to be a question you're going to get. So, answering those get out of the room questions and defining the why now. And I know Andrew's chomping at the bit.
Do we have any questions from
No,
the
I-
audience? 'Cause
I-
we're almost out of time.
It was actually to take what you said back to Mark.
Yes.
Because the first person, emerging managers, a couple people in the room, it's a different exercise. So that's kind of a longer conversation.
Right.
So let's say they're somewhat established. And so that's where I'm going to Mark, because they're not like, we didn't start last week. But if you're talking to a huge fund, you're going to get the marketing guy. That's it.
Mhm.
Now some marketing people are very informative and some are not. So you'll figure that out in terms of your relationship. Sometimes your best relationship is with the marketing person. You'll get more from them than trying to get an analyst or portfolio manager in the room. And I can get them in the room. I was running billions of dollars. They do whatever I ask. So to Mark though, so you said you walk into the room and there. So Mark, how many presentations have that org chart? You had the fund, the guy, the portfolio manager, whatever. And then how many of them said analyst, 1, 2, and they had an empty space for 3 more analysts. And the story was, well, we're at 100 million and we get to 250, we're going to hire 3 more analysts.
Because they think that's
And
what
what do you
you
think of
want to
that?
see. The point is, it's not that they're hiring 3 analysts. The point is that they can manage your money effectively and manage the strategies that they're saying. It's not how many analysts you have to do that. You can do that effectively with maybe 1 analyst or no analyst. They've been doing it so far with 100 million, right?
But that wasn't my question.
Well, what was your question?
My question was when somebody lays out their strategy to you, this is what we do, this is how we do it, this is who works here, this is what they do. And then they've got these empty boxes for the future. So what do you do? Because you're on the other side. I know what I do, but I'm not, I want people in the room to have an idea when they face this stuff. What are they looking at?
Mhm.
So you tell them.
Well, some of that is how are we going to grow? And it's what's our succession plan, right? What's going to come in line? How are we going to get people ready to take over? Suppose something happens to one of the top people at the firm. Who's going to step in and fill in? Right?
That's not on the org chart. That's different.
That's not on it, but it's a question you have in your thinking
Yes,
when you're
it's-
looking at that org chart.
absolutely.
So it goes to trust, it goes to confidence in the manager.
You know,
What's the hottest sector in the market right now for DM?
Who may?
If you're a new fund.
If you're a new fund, I'd say we're seeing a lot in the defense area.
Mm-hmm.
We're seeing
Private equity, venture capital stuff.
primarily on the venture side of things. It leans more venture. A lot of co-investment opportunities there. A lot of interesting companies being done right now. But I think Andy's got a good conversation going, not to go back.
you know,
to it.
this matter was, it could be a
I'll
venture.
continue with them.
The hottest area, I mean, so I think a lot of what's happening now, we're seeing a lot of articles about Yale getting stuck with a lot of private equity, Harvard getting stuck with a lot of private equity, and them selling them. So I think, and Carlisle just raised what, 20, so was it 2 billion or 20 billion for secondaries and private equity that are flooding the market. So I think, continuation funds is one way that private equity funds like to say they're stuck assets and continue them on in a different type of structure. So that's one way. But I think that there's an opportunity for family offices to step up and be nimble here and be investors in good opportunities. I think there's going to be one in the larger space. I think that the endowment model, people are going to refocus on how everybody was kind of chasing Harvard and Yale's performance, and that trickled down to family offices, ultra high net worths, and how RAAs have actually built their models. And now that there's a focus on maybe that was marked to model or marked to myth a bit, there's going to be a refocus on private equity essentially as an asset class and how longer term investments are viewed. I think that there's a focus on hybridization vehicles. So vehicles that can actually deliver the returns and align with the promised liquidity and differentiated strategies. I think we have to be very careful of private credit because there's a lot of interest in that. And anytime something goes from like, ooh, this is cool, to like the next year, there's like days and events focused on it. Quality matters. You have to be very careful about who you're investing with. I think less correlated, longer term, if you're going longer term opportunistic, litigation finance, for example, I think going back to Adam and Eve and the Apple, I think the next people behind them were Adam and Eve's lawyers trying to figure that out. Because like
The credit panels tomorrow will do.
yeah.
You want to be on.
People fight in good times, people fight more in bad times. I'm going through it, I know it. So just take me for that. But so litigation finance uncorrelated, farmlands uncorrelated, and finding those areas, I think that impact longevity, healthcare, as you know, the cohorts investing the money are more focused on health and longevity. Lifespan has increased 60% over the last 100 years. So people are living longer, focused on quality of life. And there's an inextricable link there, whether it's directly through your investments or how your investments impact that. And I also agree that AI, which we didn't even get to touch on, impacts all levels of a family office or any organization, but not just defense infrastructure, but digital infrastructure and protections there are just a few.
That can't miss, that didn't miss. Like Adam Kowarski came to us this year, couldn't miss. He's like a home run.
So I'll give an example. I'll give an example. So this is really cool. So and it's a great. So Marty asked like give a can't miss, right? So earlier,
You saw.
yes.
Who you thought could miss and he didn't miss.
And he didn't miss this. So I'm going to give a great one. So earlier I was talking about the RIA industry and how there's a lot of M&A and, this firm in Albuquerque or whatever, DePaul. So there was an investment firm that we with diligence and ended up investing with at the family office that helped build the World Financial Center that I was aligned with. And they had an agnostic view on the sector. So would buy minority stakes across the RIA space in a sector that was going through massive M&A change with the goal of turning those minority stakes into more majority stakes using not just equity like buyout, like you're getting old, you don't want to invest in the AI technology, you want to turn over this anyway, to company currency. So you're exchanging your DePaul small fit, RIN today for a global currency. And so that was a can't miss because no matter what the markets did, essentially there's a view on that this is a paradigm shift in the industry with a near-term liquidity event, right? This is a firm that's going to get acquired by a bigger firm because of their strategy, or ultimately IPO in the next 3 to 5 years, based on knowledge I can't share. So we, they can't miss, haven't missed, or still growing. And it's a really interesting area, and that's happening in other asset classes. There are investment companies that are doing that in accounting as well. But the RIA space is a really fascinating space right now. So that's one example of one that we thought couldn't miss, didn't miss, and did invest with.
This panel will not be complete without a question from the audience. And here we have one finally.
Do you mind? Yes, mind stating your name? Hi, Amy. Yeah. Yeah, I mean, honestly, that's an amazing question. You said Amy's question was basically, what do we see, in values and how that's going to shift how people invest. I really think we're at, almost like the dawn of a new paradigm where, and this was touched on before, but when I go into JP Morgan or an RIA or whatever, the first question I'm asked is, how much money do you have? What are your investment objectives, right? And I think that's the wrong question. I think what's happening now is the question for family offices really should be, what is your value system? What is the legacy that you have? What is the legacy you're trying to preserve? And building a pie around that. So as I alluded to before, I think the industry is looking at the wrong pie. It should be focused on value system and legacy investments, which includes your investments, but it also includes philanthropy. Philanthropy not just as charity, but as enduring altruism, as part of your strategy, governance, education of next generations at the right ages and stages. So, do I bring my daughters to an event? How do I expose them to different sources of wealth? Are they not even interested? Making those decisions and building that into the governance.
She does run the T-Mobile account.
There you go. And so, and I also think that banks have it backwards when these bigger firms have it backwards. Not only are they late to the game, originally they thought it was man, maybe like 5 to 10 years ago, they're like, oh, there's women too. What do we do with them? But it's also, applying, sorry, I'm sorry. I share my views. But it's also that, these old-fashioned models, or their proprietary GTAs, global tactical asset allocation models, are told that they're differentiated. I'm going to make you, Amy, this special investment because you're my family office. And what they're doing is they're just putting you into their same mix of the investments that they as an institution have diligenced and selected, right? I think that's totally wrong. I think that has to all be revisited, and the model has to change.
Thank you so much. I've been informed that it's time to move on.
Okay.
I want to thank our
We can
distinguished
talk more,
panelists.
Amy.